Today what I want to talk about is the dirty, ugly R word in the room, which is recession. I know that everybody and all the economic indicators are kind of saying we're not in recession. The ugly truth is we are. I'm from a market mix modelling company, but to be honest, when I talk to our customers, we don't give a fuck about market mix modelling. What we care about is market mix decision making. What are people making better decisions that improve their growth and also improve their advocacy within their organisations as it relates to investment and growth and those sorts of elements. Measurement is absolutely and utterly useless unless it is fundamentally improving your decision making. And as we're going into recession, what tends to happen is marketers tend to face changes to their decision making, changes to how they invest, pressures to invest in short-term channels, and pressures to invest differently. I hope what you're going to get from this presentation is a view as to how you should maintain your decision-making in the face of recession. So, why are we in recession? Few kind of reasons and signals that we're seeing across data, and very happy to share some of this more precisely if anybody is interested. But average mortgage holder payments are up some 50%. That's a huge rate of increase, particularly in as it relates to discretionary spending. We also have the fixed rate mortgage cliff. Now, nobody talks about it this way, but fixed rate mortgages are effectively subprime. What they are is introductory loans that have been introduced, fixed for a period of time, and the second we get off that cliff, a huge amount of the economy has their mortgages skyrocket. That cliff is coming. Most people refinanced around 2021. They will come off that at the end of the year. That is the big shock that's about to hit the economy. And of course, the early signal that you're tracking here is loan delinquencies. The number of loan delinquencies is up some 25%, comparable to subprime back in 2008. What's staggering is all the signals to massive housing crashes are there. No one is paying attention to them. Now, I'm not going to preach as to what the economists should do and the RBA should do, much as I'd like to, but I will talk about what it means for ROI. It means less consumer spend, which means less return pie. What that often means is there's a lower general trend of ROIs. Last year in MeasureUp, we forecasted that ROIs would kind of come down moderately through this year, and that's pretty much what has played out across our data sets. Channel choices tend to change significantly as sales go down because people gravitate towards short-term sugar hit channels, channels where they can see and prove ROI really quickly. One of the lovely things that we also see becoming more important is understanding price position. So one of the things we include in modelling, for example, is what's the relative price of that business compared to all other products that it's competing with. Why is that more important today? Because that price synergy will dictate marketing effectiveness. And of course, economic factors become more and more important to include in models. The amount of models I've seen not including economic factors is frankly staggering. And if you look here, what do these economic factors actually look like? It is pretty incredible to start to see how the rate of change has gone up. You can look here at the top is the overall consumer sentiment and its value within our models. And you can see how rapidly consumer sentiment has kind of come down from that 2021 peak. You can see the target cash rate jump, which is a measure of the rate of change that we track as it relates to how quickly is the cash rate changing, skyrocketed around April and has maintained a fairly heavy rate of change since positively. You can see that the CPI, the Consumer Price Index, has been steadily trending up across that 2022 period. All of these things materially affect how people buy in the economy. They materially affect what product lines are going to be valuable, what product lines you can push, whether or not you can push the expensive products or whether or not you need to cut prices, discounts, all of these sorts of elements. And these indicators have not been this bonkers in basically for the last 10 years. These are indicators that we have not seen moving like this for years and years and years. And so that's causing huge shifts as to what good looks like in terms of investment decisions and modeling. So what are marketers actually starting to respond with and doing as they're seeing these indicators come through, and what are we seeing across our data set? Now, so for context, we measure about 1.6, 1.7 billion annually now, kind of flowing through our system. We analyze that across about 65 individual brands. So it's a fairly big number. Across our data set, we track a number of indicators, but one of the indicators we're really interested in is how are the percentage allocations changing? So if I've got 100% of a budget, what percentage is going into channel A versus channel B? The reason we like tracking that indicator is it tells us how much people are adjusting their mix at an aggregate level. And what we're seeing here is something really interesting. Now, I will note, we did this graph in a little bit of a hurry. TV includes BVOD, so because we're increasingly tracking the TV channels as the networks, particularly as they move to a total TV strategy. What we're seeing here is marketers have been shifting budget broadly and keeping it, defending brand and defending search. What's been really interesting is we've seen OLV have slight declines, social have slight declines, thankfully display have some declines. We'd like to see some more for any marketers in the room. So marketers are particularly defending brand budgets using measurement to justify efficiency of brand. So what we're increasingly seeing is a lot of the numbers coming back through market mix modeling is that they can use that to kind of say, okay, this is why we need to defend this budget. There's some big challenges to traditional performance channels, particularly as some spend in the more conventional areas drops marginally. So what we're seeing is, as the CPMs have been going up, it's been harder to get efficiency in those channels. One of the interesting things I think in kind of startup land and VC-backed startups, we work with a few VC-backed startups who are kind of far more in the consumer space. And what they tend to be doing is pulling back from performance and defending brand at the moment because they've analysed the size of the pie is smaller as demand is lessening in the market. The second thing that we're seeing a lot of is finding more growth through uplift. So return uplift is something we track as a really interesting number through the data set. What return uplift means is as your kind of channel investment is going up, is the return outpacing the channel investment? And one of the things that we saw in our data set in H2 last year was that TV cluster was really, really struggling. In H1 of this year, compared to H1 of the previous year, we've started to see that start to uplift again. That's being driven by BVOD. So what we're starting to see is as BVOD is becoming better and better adopted across the market, we're seeing much, much better returns starting to flow through. Interestingly, out of home still seems to be tracking very, very well. Social seems to be coming up as investment is going up across the budgets. Display and search, not so much at the moment. Now, why we think that is because as people are going in and piling into performance channels and there's less demand, that creates a cyclical effect. If there's less people who are in the market for a particular product or in the market for a particular targeting element, but spend is piling up against a smaller audience, that creates an ugly effect where the spend's increasing, but the incremental value isn't tracking along with it. And so that's what we're seeing in the market, is what we're seeing those kind of differences starting to pull through really neatly. Now, the third area that we're starting to look at really, really closely is because a lot of marketers are asking us, well, what's the value of creativity and execution within these channels? Why should I execute better within a channel? Why should I invest more in creativity? And it's a really hard question to answer because there's no easy way to answer that. We've got things like ad stocks, we've got things like, brand equity tracking, we've got things like comparing campaign A to campaign B and using campaign hierarchies in market mix models. But we've got no way to say, this is the potential value of execution within this channel. We're starting to track that across customers through what we call standard deviation. So we're using standard deviation, which effectively goes, okay, for all the campaigns we see in this channel and for all the changes that we see in this channel, what was the range of change that we could see based on executional factors changing? Now, one of the big challenges with this data set is obviously COVID, and in particular, COVID creates a huge range in one channel, in particular, which is out of home. So out of home obviously has huge variance through that period. But this is a really interesting data point, which starts to show us that actually the standard deviation for a customer in a particular area from an ROI perspective can be absolutely massive within the channels. The importance of creativity and the importance of executional excellence can't be understated. So what marketers are increasingly doing with these data points is they're coming back and saying, well, if I don't invest in executional excellence within a channel, that could cost us 45% in social of what we would have gotten. It could cost us up to 113 in TV. All of those sorts of data points we're starting to see come through. Now, why is standard deviation important? Because we think standard deviation is going to be a metric that people have to start to track to explain why executional brilliance is important to invest in within the market. Because one of the things that's really easy to cut right now is creative budgets. One of the things that's really easy to cut right now is like investing in strong optimization or strong first principles thinking. But increasingly, what we're seeing is standard deviation tells us that's an incredibly high-risk strategy within the market. And so this is increasingly a metric we're going to be tracking. We're looking to start to push this out in terms of a benchmarking perspective across channels on an annual perspective. Because what we think is this will start to tell us the value of execution at scale within channels and why, in the middle of a recession, you should be making decisions to defend executional excellence. So I suppose as the economy shifts, as marketing effectiveness will constantly shift as well. And so if we're going to leave you with one message today, one, measure those shifts so that you can basically then manage the outcome. Because the worst thing that can happen when an economy is changing dramatically is making bad decisions that accelerate your decline. Thank you very much.
Any questions from the floor?
Just on your last point.
Yeah.
And forgive me, I'm the least measured person in the room. Are you basically saying you've got a way to quantify creative quality?
We call it executional effectiveness, right? So and the example I give on that is I could have an amazing creative execution, but if I put it on 5 billboards where no one cares about it, who cares? What we're saying is it's both. It's both. There's a deviation within the channels that we see based on a combination of creative, placement, format. And because we're seeing those deviations be quite wide, all other factors being relatively equal, that's what we're starting to kind of quantify as executional effectiveness within channel.
And does duration come into that?
What do you mean, as in duration of the ad?
Reach.
Do you mean duration or do you mean reach?
Well, either into that measurement. Are you the amount of time a campaign is up and out of home? Does that come into it?
Oh, I see. Yeah. So we do track those sorts of elements. We would call that weight in ad stock. So the weight of the campaign as it kind of sits over time. So one of the things you look to track is if a campaign's been in market longer, it kind of builds up weight in ad stock quite significantly. So yeah, we do track that.
Any other questions? We've got one. We might
There's
get a mic
one
up there because we're recording it, JJ. I think that's what Tiff was trying to communicate to you.
Talking about changes in a recession, is there, in terms of defending budget, is there a longer consideration process that we notice for users to actually get to the bottom of the funnel? So is that a consideration when defending budget, thinking investment now will pay off in a longer period?
I mean, I'm personally not a fan of funnel-based thinking necessarily. I think like the simple answer is there are less people able to buy products right now because their money is going to interest rate payments. And if you look at that as a really simple equation, that then means that there are less people able to spend on your products in a given month. How that's flowing through to different categories, I think it's like people seem to be going, I can't speak specifically to examples, but people seem to be like cutting quite specifically category by category now at a household level is kind of how we would interpret it. Like there are some categories like that are incredibly resilient at the moment, but there are others that are just starting to really start to feel the pinch. So yeah, it's a challenging one, but I just think, generally there's less demand in the economy. And that's the point of jacking interest rates, right? Like the point is to take demand out of the economy. And I think it's pretty crazy to think that we're not going to be going to, a 5.5 to 6% interest rate given the weakness of the Australian dollar and the weakness of the iron ore price. Because what that's going to do is it's going to force, in order for the Australian government to raise bond money and stuff like that to pay their interest rate bills, they have to basically match the US Fed. And so we haven't done that to date.
Henry, one from me. You've pulled out of home there. What about radio? Are you seeing anything come through?
We just didn't pull that data set for today. But if you want the full data set, happy to do a white paper with you, Guy.
Awesome. Awesome. Nice sell. Any other questions that...
You win the best shirt of the day so far, Henry, by the way. So it's good to see that focus on operational excellence and the sort of fundamentals of that, because that's something we've noticed in some of the working groups and councils in the ops roles, that there's some practices that, they need to come back. So that's a great piece. I was wondering, based on 15 years ago in the financial crisis there, do you have any insights as a result of what happened thereaafter that we can learn from now, or is it...
Well, I was in high school during the last financial crisis, so I probably not the best person to ask.
Just showing my age, really.
Awesome.
That's a no, then.
No. well, look, I think like you can kind of see the same patterns playing out. I think the biggest risk is if a bunch of housing supply comes on the market really, really quickly, and then has a huge deflationary effect on the economy. What basically happens to every single person's discretionary spending. And I think, the thing people forget about, subprime is it was incredibly deflationary, like in the sense that it crushed a lot of people's asset wealth and bases. The Australian market has its assets exceptionally based around home ownership and home wealth. So I suspect if that was crushed, has huge ramifications to spending. And if it has huge ramifications to spending, it has huge ramifications to advertisers.
Yeah, I was around. I do remember there being, particularly in Britain, a real focus on slightly evil products, a bit like payday loans and all the rest of it. We got very good at operationally targeting those just prior to the date when we knew everyone was getting paid and all of that. So I must admit that comes to mind. But anyway.
Great. We've got another question up here, Jojo.
That was a really inspirational kind of oversight of what's happening and what you think is going to happen. What are you advising clients on in regards to marketing investment based on what you're forecasting?
Well, I think like historically, and I think Paul's presentation is actually really good. Like, it's really easy to prove things through attribution models, but increasingly those attribution models don't flow through to the P&L, right? Because an attribution model doesn't measure incrementality, it often doesn't flow through to profit and loss statement, and so it can be hard for finance teams to effectively believe it. I think maintaining channels that drive incrementality and then being really rigorous about merchandising incrementality back to the business is very important. I think the second kind of thing is to look at how economic factors are impacting specific product lines. So there are certain product lines which will benefit from interest rates going down, particularly in more price-sensitive categories and things like that. We're advising a lot of customers to monitor that really closely and kind of go, which product lines are winning from the economy versus which ones aren't winning. The third thing I'd say is if you see certain product lines winning or losing, doing qual testing to validate, because like The thing about an MMM is it's not ground truth. You do need to validate it elsewhere, either through experimentation, but also through qual testing. And so we're advising a lot of customers to go, okay, if you're seeing that change come through in the MMM, run qual tests to see, have consumer preferences change in relation to your product portfolio, and will consumer decision-making change based off, if the interest rates are at X or whatever. I think by doing that, that at least starts to get people planning the distribution of their portfolio and budgets more aligned to where the market is going. Because as organisations, too often we plan budgets by brand, but not by portfolio distribution. And portfolio, as consumer preferences change and demand changes across your portfolio, you should be looking to reallocate money as to where it's most effective. And that's the benefit of having a multiple brand or multiple product line business, is you can reallocate money to what's most effective. But I don't think enough people leverage measurement to do that quickly.
That very eloquent answer actually answered one of the questions on here perfectly. There is another one, which is about wanting to dig into your opinion on display there, Henry. What's going on there? Can we open up? We've got 5 minutes.
I'll just stand right near you.
It's a hard channel because there's a lot going on in it, right? Like, I think if you go to more premium display assets, there's obviously a strong case for that, like digital billboards. But the problem is the display environment is like, hundreds of different, systems all talking to each other and things like that, and it's pretty hard to know what's going on. I think that shows up in ad effectiveness models and in models generally, where it's hard to show consistent incrementality out of the channel unless you start to break it out by publisher. And that's when you start to see the differences coming through. So I suppose my opinion there is more related to, don't do it blanketly, do it intentionally. And in the same way that most people would go, okay, we're going to buy ads on these publishers in above the line because we believe these are premium assets, they'll show up for this reason, things like that, and then we'll do a slightly longer tail. But in display, we kind of seem to do it the other way around. We kind of, pour all the money into programmatic, and then we go, okay, now we're going to just do some intentional things, on the side. And I think that's probably the challenge with the area.
You've got to work harder.
Yeah, and it feeds into that early sustainability discussion. And that's one thing I wanted to ask you. So obviously a lot of your models have really amazing power, but a lot of computational power. How are you thinking about sustainability as a business?
I've got a burn rate, so I'm not thinking about that, to be honest, at the moment. Once we get to profitability,
You'll think about it,
start
yeah.
to think about
Okay, awesome. That wasn't payback for display, by the way. No, but I agree. Display needs to work hard, right? It needs to be intentional. And I think a lot of the work, interesting. As an industry, some of the stuff we talked about earlier, like MFAs, getting rid of wastage. Maybe we have a target as an industry to change Henry's overall number for display and get rid of 20% of the stuff that's not doing anything and see if we can get an uplift.
Yeah, that'd be fun. It's like anything. It was ever thus. You've got to be operationally excellent at what you're doing. There's got to be targeting, think through the creative, think through the messaging. That's just best practice.
We do have one customer who does break out their inventory in display by a sustainability on a sustainability metric, and it does show a higher ROI. We don't believe it's linked to the ESG side. We just think the ESG side naturally gets a higher quality of inventory.
Yeah.
And so it kind of has that nice correlating effect, if that makes sense, of it just naturally gravitates towards higher inventory.
Yeah, that's brilliant. Thank you so much, Henry. That was